So we're going to talk about swing trading today, and I'm going to give you a method that I use on a day-to-day basis. And my goal is always to simplify the method, everything we do, my explanation of why I do it, and so on. So let's get going here. We got a short amount of time, and of course, want to give you everything I possibly can in that amount of time there. So let's get going here. A little bit about myself. I've been doing this a long time. Started educating myself in the late 80s, knew absolutely zero. Um, After a lot of trial and error, I founded a company. Some of you may be aware of it. It was called Pristine Trading back in 1994. Eventually gave that up, sold it to another company, and did a lot of trading challenges, educated a lot of people over all of these years. Some of them probably most likely. You can see a list at my website where you can go and read about myself. And there's a short list there of some of the educators in this business that I've educated. And it's a testament to what I've been doing all of these years, teaching them a method that they now teach today on their own. So you can check that out if so interested. So I started out, I think, how most do, and that's with the indicator-based methodology. It's virtually impossible to sidestep it when you come into this industry, whether you just open up any platform that you can get today free on various websites, paid for platforms like eSignal, TradeStation, Realtick, and so on. You're just overwhelmed, and show that you need all of these different. Well, you don't need them all, of course, but there's so many different indicators. There's so many different settings to them. The choices as to which one to use, what to set them to, which is the right one, and so on, is what I call brain damage. I went through that trying to figure it out. Even back in the day when I started, there was no internet. We downloaded data over a phone line into a 286 computer. But even the platforms back at that time had indicators. So I went through all of this trying to figure it out, eventually getting to the point where I couldn't make money doing it. And analysis paralysis of these, and this is just a short list of what's out there today that you can pick from. So eventually, all of these questions as to which one, what settings, and so on, and it does become overwhelming to say the least. So what did I do? I removed them all. I took all of those indicators off my charts. I removed the horizontal lines connecting the whole numbers, the half numbers, and so on, because they came into play that created moments of indecision. Will the prices stop at the horizontal line? Will they stop when things are overbought or oversold? Or the questions and thoughts that'll run through your mind are endless. So removing all of that, the light bulbs start going on. And you need to have a trading plan. And if you've been doing this for any length of time, you've heard the need for a trading plan, which is a set of rules that say, if this, do that. If it doesn't work, stop loss. So, and how to manage the trade. So keeping it simple, stupid is the way we're going to do it. How? I have to define a trend. Is it going up? Is it going down? Is it going sideways? I need to do that without trend lines, without indicators, without fib lines, without GANs, anything, even the esoteric stuff, because it's not necessary. Candlesticks, how do we simplify that without knowing names and being overwhelmed? The less we can think, the better we're going to be, meaning the thought process is outlined ahead of time based on price action. Doing that in multiple time frames when they're in alignment. How many time frames do I look at? Which ones? Well, again, the different selections there as to which ones are many, with the evolution of tick charts, time-based charts, and so on. So you have to make a choice. Best thing is to keep it simple and keep it to a couple of time frames that you will use, because you're really not going to gain an advantage by looking at, say, a 4-minute chart versus a 5-minute chart. That's misleading information. What you need to do is stay consistent in what you're going to use. So we need to have a foundational setups to use. What are they? How do we enter trades, buy or short? Well, it's either a retracement type of a pattern where prices are in a trend and they pull back, or they're in a downtrend and they retrace to some point and we find a pattern, or we're trading breakouts and breakdowns. Now we need to simplify that as well, because again, when we get into the different types of patterns, whatever you want to call them, right? It's either pulling back within the uptrend, or it's retracing within the downtrend. What that looks like is going to change based on the time frame that you're looking at. So you may have been in a situation where you look at one time frame and it's one bar, another time frame it's multiple bars. So we need to understand how to visualize, see these different time frames and when they're in alignment. Money management is the most important thing in this business. Very few will focus on it at the beginning. Right? Why? Because they're focused on making money, not necessarily managing the money. So they get into bad situations where many people that could make it in this business don't, because they lose too much money at the beginning. So let's go through the method on how we're going to interpret this in a symptomatic way. So a trend, define what the trend is. Right? It's simply higher highs and higher lows. And how do we define that? Well, we have to define that as to what is, let's say, a pivot high, PH, or a pivot low, and we then have to define that. So we're just going to simply say that this pivot low is a bar with 3 higher lows to the left and the right. You might say, well, Greg, what about 2? What about 4? What about 6? Well, I've looked at all of that, and we have to come to a agreement as to what works very well the majority of the time. And what I found is 3 works really well the majority of the time. It's not perfect, but it works. And so now once we have that pivot low and it makes a higher high, I will then call that MS, or major support. And when we get a series of pivot highs and pivot lows that create this prior swing low as major support, if it violates that low, it's no longer meeting the definition of an uptrend. And it'll break the uptrend line every single time without fail, which will confidently tell you there's no need for trend lines, because you know it's going to happen 100% of the time. And there aren't many things in technical analysis that you can count on 100% of the time, because there is uncertainty in the markets, meaning uptrends can break the trend and then reverse and resume an uptrend, or vice versa. So that has to be accepted as an unknown, and you have to then go with it. Right? Downtrend is simply just the opposite. Lower highs and lower lows, and if it should violate that definition by trading above what we call major resistance, it will then violate the trend line if you choose to connect the dots, so to speak. When it rises above that reference point, it'll break that trend line. Now, trend lines break and they don't violate major support, meaning if this is a steep downtrend and it could violate that trend line, it won't violate that major support. So the trend is still down. So this is part of the subjectivity that you will experience when you are using trend lines and connecting dots, so to speak, and why you don't have to do that. Now, how do I, there we go, erase all the drawings. Let's continue. All right, so as I said, pivots, 3 bars to the left and right create a pivot bar. In this case, the trend is up. It's making higher highs and higher lows. And so now we have those pivots marked. And as long as it continues to meet that definition, we say that the trend is up. Now, that doesn't mean that we're ignoring a situation like we have here, where the depth of retracement was this deep. That's a warning sign that there's the potential to violate that prior area of major support. And we recognize that. It's part of our analysis to objectively say, hey, you know what, this big down bar here, that really isn't a good thing. You know, that price is pulled back because when there is, let's say, an agreement between buyers and sellers where one side is overwhelming the other, in this case, their buying power to absorb that supply that's coming into the markets, you have relatively tight ranges. You have fewer pivot lows and pivot highs because things don't pivot. They trend very tightly. When the pivots and highs and lows start to create frequently, we know that things are getting very erratic, similar to what's in the market right now. When certainty comes back, things tighten up again and you get fewer pivots. Now, this is a weekly time frame, and a smaller time frame will get more pivots. Harry, a pivot high and a pivot low is simply a bar with 3 higher lows to the left and the right is a pivot low. 3 bars to the left and the right is a pivot high. So this software is just marking them off. You can visually see it, but the software will mark it and just say, hey, there's a pivot. So you can just look at the chart and say, oh, well, it hasn't violated one yet. The trend is still up. In this case, the pullback was relatively steep. So I like to, everything that I teach, I like to call it a thought-building lesson, because that's what it is. Right? As I say, proper trading is proper thinking. How do you know what to think? Right? So as we look at the charts, right, they're telling us what to think. That data is being created on the screen by you and I and everybody else that's trading. So this is what's called pattern recognition. Right? Does pivot high happen after 3 bars to the right? Correct, Richie, after 3. If there's 3 to the left, you can have 1 to the left and 3 to the right, and it's not going to be marked as a pivot. So you have to have those 3 higher low bars to the left and 3 higher low bars to the right to be a pivot. Right? So pattern recognition, it's a recurring arrangement of price bars that suggest the future of price movements, which produce thoughts. You see a big red bar in an uptrend, you're probably going to get some palpitations if you're long, right? Especially if you're not using proper money management, if you've oversized the position. Right? But that big red bar doesn't necessarily mean the trend is going to be violated. So these patterns communicate to us how other traders have acted. Right? If you buy and I buy, someone else sells, all of those transactions are being created by beliefs and expectations in the time frame we're viewing, and that creates patterns. Right? That's what pattern recognition is. So if you're looking at time and sales, which I'm not suggesting you do unless you're a hyper scalper that'll drive you crazy and you'll probably give up good trades, you're just your charting package is taking all of that information and it's now forming patterns. Pictures, simply making pictures that we recognize. The amount of pictures are endless as to the different variations. So again, we have to simplify this into what I call candle language. Right? So here's a simple little guy here where things were going up, and this, just imagine you're long and you see this big green bar and you're just counting the dollars before they're in your pocket, of course, because that bar says it's going to keep going up. Now the next bar, this big giant red one, you're going to change your thinking about what's happening, and it's going to suggest the prices are going down. Like I said, one bar doesn't change the trend, but it's one piece of information that has now become available to us that we have to incorporate into the chart that we've already been looking at. So simplifying the candles. So here we're looking at different variations of bullish patterns. So as I look at that, this is just a simple pullback pattern. I call it a master trader buy setup. It's pulling back, excuse me, within an uptrend, ideally to a prior area of price support, and we get a reversal bar. What is it called? In reality, who cares what it's called? It's several down bars followed by a green bar, right? A red bar ignored. Well, sometimes there's red bars within an uptrend. Big deal, right? We get red bars within an uptrend. Well, if they're ignored, that's telling us that buyers are still in control. That pullback of the red bar, buyers stepped up in a smaller time frame, and it should continue. So it's information that we can utilize. Breakdown failures. Breakdowns happen where prices go sideways in an uptrend. They break down and reverse. Another piece of information that I could either use to confirm my trade where I'm long, or I could use it as an entry signal. Now this one here I finally call it whatever you want. It's going up, right? So you might read a candlestick book and that might be called a morning star or whatever the name is. It really doesn't matter to me, so don't hold me to it. It's just it was going down, it stalled, and it went up. And if I condense any of these, it might look like this in a higher time frame. So as we change time frames, the pictures change. Point here is to understand that these different variations are communicating to us that prices should continue to go higher. MTS, Harry, is what I call master trader strategies, master trader technical strategies. Now, 4 foundational patterns. Again, I said there are endless variations here. And if you start thinking about different names that I might call something a master trader buy setup, someone else might call it something else, and you start thinking along those lines, right, we have to still simplify that. I create names to what I teach so that when I'm communicating with you, whether it's in our chat room or through a newsletter, you just know that that name means what I've explained to you. Meaning, so here's a retracement pattern, right? Whether it's pulling back in an uptrend, or it might be a climactic kind of a sell-off and a buy setup, or a retracement and a downtrend. Retest and failure patterns. Well, the retracement pattern could turn into a retest and failure pattern. So as prices evolve, more data becomes available, a prior pattern or picture can evolve into something else. So as I look at these bars that are forming patterns, I continually update that information as it's presented to me, and I do it objectively through my method, my thought process. I don't know, someone can answer Jurgen about sound. I think everyone else hears me. Flag patterns. You probably heard people call things a bullish flag or a bearish flag, which is nothing more than a momentum type of a move that creates an area of support. Right? Momentum move creates what I call a price void. In other words, there's no support underneath it. But that move, the demand was so strong, of course there's no pullback. So that is an igniting type of a move. And if buyers are that anxious to get in, where most of us want some kind of a retracement pattern or a breakout, that communicates to us that the demand is still so strong. And in a bearish one, the supply is still strong that it can't retrace up to resistance. So it creates this support or resistance, or what's called a flag pattern. So how it happens, it could happen many, many different ways. So don't get caught up in that it has to be exactly a certain way. And a base, right? Is it 8 bars? Is it 10 bars? Well, one day it can be 8, one time it could be 10, another day it might be 15, right? And it all depends on the time frame that you're utilizing as well. So the point here is to be flexible, to have rules, but still be flexible in what we're looking at. Right? Micro time frame, macro time frame. What we're looking for is a match here. So as prices are trending up the line in a micro time frame and they're pulling back to support, and the higher time frame, and since we're talking about swing trading, that weekly time frame, which I've just shown as a line, right? We already know it's going up, and this is pulling back. I know the odds are in my favor because 2 time frames are in alignment, and it should continue to go higher. So we're looking for these to be in alignment. We're looking for a retracement, and we scan for these retracements and or breakout patterns when they're close to the 20 MA on that daily time frame. Here's an example. It's making higher highs and higher lows. I don't have the pivots marked here, but it's moving up, and we're now looking for pullbacks where the 20 MA is pointing higher. Now, realize that 20 MA pointing higher is the same. This is a weekly chart, is the same as a 100 MA on a daily chart. So those that are going to want to look at a 20, a 50, an exponential, a weighted, 4, 5, 6 different moving averages, you get what I call a spaghetti screen. So if you're looking at a weekly time frame with a 20 MA, you already know where the 100 MA is on the daily. I look at the 20 and the 50. I'll look at a 200, but if it's in a strong uptrend, it's going to be nowhere near the 200 on a daily time frame. So we're looking here. Here's a retest type of a pattern, right, on the daily time frame. The 50 is rising, right? That's equivalent to a 10 MA on the weekly time frame. So I know the daily, the weekly are trending up here. Bar by bar analysis, retest pattern, bottoming tail bar, it should go up. That's enough for me to press the button. 20 is above the 50, both are pointed higher. Retest pattern toward the 20. So we've got, sorry about that, we've got this little retest right here, right, where momentum stalled. There was a retest, what I call a bottoming tail bar, call it whatever you want. It's a pattern in near the 20 that says it should continue to go higher. So we go with it. Right? And you could use options for these type of trade setups here. But what I'm talking about here is actually buying the stock. But you could use options as well. Of course, the right ones, but options can be used. And there's another example, basing pattern here. So strong momentum move higher. Now, this is a guide, and it works quite well. We're at 20 MA on the daily time frame where prices consolidate sideways into that moving average. And the bar by bar analysis, as I call it, right, was something that I created many years ago to kind of keep me in the moment of continuing to analyze what's happening. I see red bar ignored, red bar, topping tail ignored, another one ignored. Buyers continue to step up in this area, and that tells me that demand is strong. So clearing these highs after this resting point of refilling the tank, so to speak, should continue to move higher. Now, is there any resistance to the left? We haven't talked about that, but you need to look over there and see. But also notice how the move started. Giant momentum move, power, wide range bars to the upside, and then the resting period that builds that support point. So here we're reading what's happening here. We don't need any indicators. Just keeps it really, really simple. Right? Now, money management, I said, is such an important key to doing this. So in this example, right, you've got this strong move up. You've got this pullback. Let's just assume we're going to buy this above this bar's high with a stop a little bit below the low. So it's 15 cents. If I'm going to risk 300 bucks, I can buy 2,000 shares, and if it trades below that, I'm out 300 bucks. If that is not an acceptable loss to you, less shares. It's that simple. Now, we've got other choices here and how we can do this. Meaning, what if I want to give it more room, especially in the current market that is quite a bit more erratic? And I say, well, you know what? Here's that major support point down here. I'm going to give it room all the way down here. I'm going to give it 30 cents. And I said, well, Greg, it may not go down there. And if I buy the 2,000, it goes up. I'm going to make a heck of a lot more money. I go, sure, but you still might get stopped out because it's in an uptrend, and it's going to work out because of that uptrend. It's just a wiggle. So I'm going to give it a little more room. And now this becomes a choice. Do you want to give it 20 cents? You want to give it 30 cents? You want to give it 60 cents, right? So if you do the 30 cents and it's down here and it pulls back and it recovers back up again, that's new information. and it could produce a new buy setup. And so you can say, well, now I'm going to add the other 1,000 shares to the position. So there are many different variations of using this money management once you learn how to use it. They're all simple moving averages, Moses. I don't find any advantage to using exponentials. There might be if you are maybe trading Forex. The point is, use what the majority of other people are using. When we're looking at equities and the S&P 500, the NASDAQ 100, the Dow, I've just found that simple moving averages are more widely used. And if they're that much more accurate, that means institutions are focusing on them as well. So the thing is to stay consistent in your method. Everyone will tell you, use this moving average exponential, use this moving average length because it's a Fibonacci number. That is hocus pocus type of information. Look, even if you were to go with, say, a 13 MA exponential, just be consistent in what you use and don't make yourself crazy with, all of this analysis. So if you stay consistent and you have a method, money management, you'll do just fine. So time clicking away here, what we've covered, I know I've gone fast, but you'll get the recording. So this is what we have to use. Right? Utilize a simple approach, define the trend, understand the patterns, bar by bar analysis. Swing trading, multiple time frames. If you're an intraday trader, you could say, I'm going to use, like I do intraday, the 60 and the 5 minute. If you could say, I want to use the 15 and the 2, go ahead. Consistency in the approach, right? So there are different choices based on where you want to operate in the markets within the time frames. We have foundational patterns. The patterns are endless. Keep it simple. That's the whole point. Money management, as I explained, we go into greater depth in that in the courses. We have to develop a market bias. The market will pretty often drag the majority of stocks around. However, in a down market, what stays up shows relative weakness. I should say relative strength. If something market is going up and a stock is going sideways, that's probably not going to be a good breakout candidate. However, something that is going down and the market's going up is clearly obvious, and you don't need relative strength weakness charts to do that. I could just recognize that something went up, the market went up and something went down. The internet sector is going up and this particular stock is going down. S&P 500 is going down. The communication sector is going up, and just, is it rising above the 20 or below the 20? It's really, really simple. Market internals and intermarket analysis, adding those are what I call the three-legged stool to the analysis. Patterns, technical analysis, I explained, market internals, intermarket analysis, how are different markets relating to each other. So when we talk about how different sectors are affecting markets or how bonds are affecting, so interest rates right now are a big focus with the yield curve. So, okay. I have a swing trading course that covers this and a tremendous amount more, which I'm offering here. It's on the website, so at $7.95 every day. So it's not that I'm offering you a special price in here. It's a tremendous course, but what I am offering is a month free in our chat room where you'll see my partner and I do this in real time every day, trading either that particular ETF, that particular stock. We may use options. I use futures a lot as far as the indices go. So all those trades are posted, they're tracked. You can access that. You can ask us questions in the room. As far as our newsletters go, everything is updated through text messaging and email services. But if you're in the room with us, there's education every single day of the week in that room. So I think actually I kind of lost track of time here a little bit. So if you guys have questions or want me to go back to another slide, I think I've got another 10 minutes here. since I know I did go pretty fast and can cover some other stuff, I'm happy to do that. We usually do things in this presentation in a half hour, and I know it's been changed to 40 minutes now, so I went pretty darn fast. What we get in retaining. I'm not sure what that means, Mike, what we get in retaining. You get the course, lifetime access, coaching on a monthly basis, which we do live in a chat room where either my partner and I are showing charts, taking your questions. So you get access to the course, lifetime access, the training. Does Elliott Wave ever influence your decision? It's impossible for Elliott Wave to influence my decision, Michael, because I don't look at it. You know, there's waves and trying to waves. To me, that's hocus pocus in information. What is the ideal market to trade nowadays? It's a good question. I've been telling our subscribers to be an intraday trader now since over the last month. Things have just been chopping back and forth quite a bit. The defensive sector has been doing pretty well. Consumer staples have been doing well. Those are defensive sectors. Is there a separate room for the room? Absolutely. If you are a student or a subscriber to any letter, it's $97 a month. If you're not, it's $147 a month. What market internals do you go over regularly? If it is for the swing trading, which I cover in this course, breadth internal, sentiment internal, and I show you how to combine those together for buy and sell signals, for swing trades, for intermediate market analysis. For intraday trading, in the chat room, we monitor the NYSE tick and the total put call ratio for extremes. We don't look at patterns in those. We just monitor alerts where we're setting extremes for those. And you would be amazed at how accurate they are on a short-term basis, even more surprisingly so, to see when option traders are buying an excessive amount of put options, how the market holds and will begin to rally or vice versa. Do you evaluate macro or global influences? Well, that would be intermarket analysis, Perry. So there's been a big focus this time around on yield curve inversion. No one spoke about it back in 2000 or 2007 and 8 when it inverted. Today, as people become more educated and how the media becomes more educated, information flows a lot faster. So there's been this big focus, and when the market went down earlier in the year, was just the threat of a yield curve inversion. Now that it even happened, so that is more of a macro focus, as well as evaluating with interest rates what are transports doing. So transportation index monitors stocks that are delivering information, goods and services. If that is underperforming and interest rates continue to decline, right, that is a bearish sign for the markets. So it's really simple. Everything that I focus on is to simplify and eliminate overlapping information. Do you take a trade against the major trend and when? Yes, absolutely. That's what I call a climactic buy or sell setup. And as we look at patterns, we can recognize that as to say, if prices are falling rapidly and they get extended from support or resistance, they're getting closer to the end of a move. This is when we can utilize a smaller time frame to enter. So whereas, let's say, from a swing trading perspective, the weekly chart has now become quite extended from the 20 MA. And now we've even got a wide range bar at the end. And the daily time frame has formed an M type of top, a retest type of a pattern. That is something that I could short. Is there only a 5-day trial for $7? Yes, we do not give a 30-day trial or a free trial. Too many people, it's in human nature. If you're not paying for something, you tend not to pay attention to it. Meaning a lot of people will take trials to this letter, this chat room, or whatever that might be free, and they can be all over the place and don't pay really attention. So you put a little skin in the game. Same thing with not paper trading and actually buying the stock or shorting it. You're going to pay attention to it. So if you are with us for 5 days and you say, you know what, Greg, I really like this, but can you give me another 5 days? I bet you can twist my arm to do it. And I don't want to force you into doing something you're really not ready for, you have questions about. So it's something that we certainly would consider. I don't think you need 30 days to know whether what you're hearing makes sense or not, or whether what we're doing can make you money. So, give it a try. What you'll find is that what I'm presenting here is what you'll hear in the room every single day. And so by repetition of hearing that information day in and day out, it becomes second nature to you. Do you recommend brokers in Europe? No one that I would know of there, but I use Interactive Brokers. So I know that, that is a very large brokerage firm. So whether in whatever part of the world you're in, you could open up an account there and they can access you. I connect that my brokerage account to 2 trading platforms, eSignal and NinjaTrader for futures. So they incorporate into that seamlessly. And when I place the trades that manage through those platforms, it sends the order to Interactive Brokers and it happens instantly. Could you send a link for the trials? If you just go to my website, Chuck, and just go to the green room, that page, you can just click on the trial thing. Okay. Greg, just to help people decide, I have taken your course and it is the best education out there. Thank you, Sunday. Thank you so much. I didn't pay anybody to do that, right? Do you trade puts and calls or complicated option strategies? My partner, Dan, is an option specialist. That's pretty much all he focuses on. I tend to focus on very simple option strategies as he does. I don't like, I don't look at even things like Greeks, because if you're using a chart, I've just found that you really don't need them. So you may hear people talk about Delta and Thea and this and that. Look, if you just stay close to at the money, or if you have a strategy that you want to trade something out of the money because the chart sets up, but we manage on the chart. Those that don't utilize charts with their options are missing a huge advantage, and that's why they roll, meaning they can't decide a direction, so they're constantly rolling their losers, hoping that things work out in the future. And so I don't like complicated. I don't even like the word complicated. If it's complicated, I'm moving in the other direction. And so our goal is to simplify everything as possibly as it can be, so you're not overwhelmed with the analysis. So with that being said, I have utilized my 40 minutes. I hope that you learn things from this presentation. And Dave will send out the replay, watch it again. I apologize for losing track of time there and going as fast as I did, but take a trial to the room. You'll get education every single day. So that's it, guys. Thank you very much for inviting me, and to talk to you soon.